What if I told you that the secret to building serious, life-changing wealth isn't about hustling 24/7, picking hot stocks, or timing the market like a Wall Street guru? What if the key was actually to be lazy? It sounds completely backward, right? We're taught that wealth comes from constant effort, complex strategies, and staying ahead of the curve. But for the vast majority of people, that approach leads to stress, high fees, and disappointing results. Today, I'm going to pull back the curtain on one of the most powerful, yet brilliantly simple, investment strategies ever devised. It's a strategy that allows you to build wealth steadily and automatically, a financial engine that works for you while you're at your job, spending time with family, on vacation, and yes, even while you are sound asleep. This is the lazy portfolio, and by the end of this video, you'll have the complete blueprint to build one yourself. Deconstructing the lazy portfolio. What is it really? So, what is this magic-sounding lazy portfolio? Let's be clear, the name is a bit of a marketing gimmick. It's not about being irresponsible or neglectful with your money. It's about being smartly passive. It's about efficiency. The core philosophy of a lazy portfolio is built on a few powerful, Nobel Prize-winning ideas. 1. You can't reliably beat the market. Decades of data show that the vast majority of professional, highly paid fund managers fail to outperform the overall market over the long term. They try to pick winning stocks and time the market's ups and downs, but after their fees and trading costs, they fall short. The lazy portfolio doesn't try to beat the market, it aims to be the market. 2. Diversification is your shield. You've heard, don't put all your eggs in one basket. This strategy takes that to the extreme. Instead of buying a handful of individual company stocks, you buy thousands of them from all over the world, across every industry, all in one go. This insulates you from the catastrophic failure of any single company. 3. Costs are a guaranteed loss. Every dollar you pay in fees is a dollar that isn't growing for you. Lazy portfolios are built using ultra-low-cost index funds. These funds don't have expensive managers or research teams. They simply track a market index, like the S&P 500, which dramatically reduces fees and boosts your long-term returns. The laziness comes from setting up this diversified, low-cost system and then having the discipline to leave it alone. You let the global economy do the heavy lifting for you. The 3-fund portfolio. Your simple blueprint to wealth. Okay, let's get to the nuts and bolts. The most popular and highly recommended version of the lazy portfolio is the 3-fund portfolio. It's elegant, powerful, and all you'll likely ever need. It consists of just 3 broad market index funds. Component 1, the Total Domestic Stock Market Index Fund. What it is. This is your engine for growth. This single fund buys you a small piece of nearly every publicly traded company in your home country. For investors in the United States, this would be a fund that tracks the entire US stock market, like Vanguard's VTSAX or an ETF like VTI. Why you need it? Your domestic economy is a powerful force. This fund gives you a stake in the innovation, profits, and growth of thousands of companies, from the largest tech giants to smaller, emerging businesses. It provides robust growth potential over the long term. Component 2, the Total International Stock Market Index Fund. What it is. This is your global diversification. This fund invests in thousands of stocks from developed and emerging markets outside of your home country. Think companies in Europe, Japan, China, Australia, and more, e.g. VTIAX or VXUS. Why you need it? Over 50% of the world's stock market value exists outside of the United States. Ignoring it is a massive unforced error. Sometimes your home country's market will do well, and other times international markets will lead the way. Owning both smooths out your ride and ensures you're capturing growth wherever it happens on the planet. Component 3, the Total Bond Market Index Fund. What it is. This is your anchor, your shock absorber. This fund holds thousands of high-quality government and corporate bonds, e.g. VBTLX or BND. Why you need it? Stocks can be very volatile. They go up, but they also go down, sometimes dramatically. Bonds are the opposite. They are generally much more stable. When the stock market panics and crashes, bonds tend to hold their value or even go up. This provides stability to your portfolio, reduces your overall risk, and gives you the psychological courage to stay invested during tough times. It's the part of the portfolio that helps you sleep at night. Your asset allocation, the percentage you put into each fund, depends on your age and risk tolerance. A common starting point for a younger investor might be 60% domestic stocks, 20% international stocks, and 20% bonds. Someone closer to retirement might choose 40% domestic, 10% international, and 50% bonds. The key is to pick a mix you're comfortable with and stick to it. Setting it up and putting it on autopilot 1. Choose a low-cost brokerage. Open an account with a reputable, low-cost brokerage firm like Vanguard, Fidelity, or Charles Schwab. These firms are pioneers of low-cost index fund investing. 2. Select your funds. Inside your account, you'll purchase the 3 types of index funds or their exchange-traded fund, ETF, equivalents we just discussed. 3. Automate everything. This is the most crucial step. Set up automatic recurring investments from your bank account into your brokerage account every single payday. Whether it's $100, $500, or $1,000 a month, make it automatic. This is called dollar cost averaging. When the market is high, your fixed dollar amount buys fewer shares. When the market is low, that same amount buys more shares. You are automatically buying low without ever having to think about it. This automation is what makes the system work. The money is invested before you have a chance to spend it. The portfolio grows without any further action required from you. The hardest part: doing nothing. Setting up the portfolio takes maybe an hour. The real challenge lasts for the next 30 years, doing absolutely nothing. You will be tempted to act. The news will scream about a market crash. A hot new tech stock will promise to be the next big thing. A pundit will predict impending doom. Your job is to ignore all of it. Your lazy strategy is based on the knowledge that markets have always recovered from every crash in history and gone on to new highs. By trying to sell at the bottom or jump on a hot trend, you are almost guaranteed to hurt your long-term performance. Being lazy here is a form of discipline, the lazy path to freedom. Think about the power of this. You're not just investing, you're buying yourself time and peace of mind. While others are stressing over daily market fluctuations, you're building a globally diversified, low-cost financial machine that compounds your wealth day and night. This isn't a get-rich-quick scheme. It's a get-rich-for-sure plan, built on decades of evidence and common sense. Thank you so much for watching. I truly believe this strategy can change your financial life. And if you found this video helpful and want more straightforward financial wisdom to build a better future, please hit that like button and be sure to subscribe to my channel.